As we continue to explore varied strategies for navigating the Indian equity markets, we now shift our attention to a balanced and time tested investing philosophy, growth at reasonable value, or GARP. In a market as dynamic and diverse as India, investors are constantly walking the tightrope between chasing high growth stories and staying mindful of valuations. The GARP approach offers a pragmatic middle path, seeking companies with solid growth potential but without overpaying for that growth. The next session, titled Growth at Reasonable Value Investment Approach for Indian Equities, will delve into how this strategy can help investors compound wealth meaningfully while managing downside risk. And who better to speak on this than Mr. Bhavin Shah, founder and CIO of Sameeksha Capital, a name synonymous with risk-adjusted outperformance and uncompromising integrity in the investment world. With a career spanning nearly 3 decades, Mr. Shah is one of the most awarded professionals in the industry, having achieved an unprecedented decade-long streak of #1 global rankings from the institutional investors. Over the years, he has played pivotal leadership roles in establishing top-tier equity franchises across geographies, from JP Morgan globally to Credit Suisse in Asia and Equirius in India. At Sameeksha, he continues to deliver performance marked by both discipline and principle. Please join me in welcoming Mr. Bhavin Shah as he walks us through how the GARP philosophy is not just a strategy, but a mindset for a long-term investing success in Indian equities. Ladies and gentlemen, Mr. Bhavin Shah.
I know what it takes to listen to one after another presentation on investing, so I'll try to keep it interesting. I think disclaimer that please don't treat it as an investment advice, and it's just a information session. Just a little bit about us. So I have spent my career spanning over 30 years now, investing in global markets, technology space, investing in India, particularly over the last 10 years. And I have my own investments in both India as well as in global markets, particularly US. And that is what we offer to our investors. The idea behind Sameeksha was that I wanted to do something that I start at age of 50, but can keep doing maybe as long as mentally and physically I'm able to do. Obviously, we know that some of the legends of our industry have worked well into their 90s. So with a very long horizon of starting something, I started Sameeksha. So whatever money that I had in my savings is in the Sameeksha's fund. Whatever happens for clients happens for me. I don't have any side pocket, any other private portfolio that I personally manage. So that is 100% alignment. So that is the first and foremost thing. Second, I come from engineering background. I designed microprocessors before I moved into this field. So that there is some bit of engineering mindset, process-driven orientation, focus on details, and use of technology. That is extremely important to what we do. We're probably one of the very, very few firms in our industry who have our own software development team, and actually very strong software development team. And that team aids everything we do: research, operations, fund management, and so on. We have had good success so far. And I'll go through some of the numbers on that. We invest across market cap, but we particularly enjoy, I think one of our earlier speakers talked about small cap. We also have a good exposure to that space, but we are a flexi cap investing across market cap. Uh, so, investors who trusted us in an early stage have with us. I think it's reflected in tenure of our clients. Also, a lot of people come to us based on word of mouth. We don't have a sales team. Obviously, the partners like PMS, AIF do talk about us with investors, but most of our business comes directly from investors who hear from other investors, and those investors tend to stay with us through up and down, and I think over longer term they have benefited. I'm doing this in reverse. I'll talk a little bit about performance. I'm very proud of it, and then talk a little bit about strategy. But just to bear with me, we have had very strong performance both versus Indian market and US market. And there is a separate session in the afternoon where I'll talk about our global market strategy. We have both PMS, which is running for now 9+ years, as well as AIF, which is now running for 3.5 years roughly. And both have broadly similar strategy, although in AIF we can do more things, including IPOs and so on, and have had strong outperformance. But I think what is more important is not performance as of today, but what we have delivered on a consistent basis. And I want to emphasize this data point quite a bit. We have completed, as of June, 52 rolling 5-year periods, starting from March 21 being our first 5-year period. In every single 5-year period, we have delivered meaningful alpha. When I say meaningful, I'm talking about average alpha of 8-9%. In every single period, we have been in top 10% of all PMSs. So that is the consistency. Pre-COVID, during COVID, post-COVID. Pre-COVID includes first couple of years when we were still learning about a lot of companies, and sometimes by the time we finished understanding the business, the stock would have run up. So we had a lot of cash in the portfolio. Average cash level was 17%. But still, we delivered alpha. If you take a cutoff of 29 February 2020, just before COVID. During COVID, obviously, everybody did well. We did well too. And post-COVID, in fact, outperformance alpha has increased. And all throughout, we have had meaningful cash in the portfolio. So we are never, and this is despite that. This is again the rolling period data since inception. 5-year, if you take the average of all the 5-year rolling periods, we have had 9.5% alpha. And if you take any other period, we have had meaningful alpha. Some people then argue, you have high exposure to small cap at times. So, what index should you compare with? So we have even created a custom index, which is the red line, which looked at the portfolio weights in small, mid, and large, and use that to create an index. And obviously versus that also, there has been a strong outperformance on a financial year basis, calendar year basis. But performance has two aspects in our view. One is absolute returns you get. Second is the risk we take. And this is where our, most of the evaluators, country's top wealth managers, they notice something about our performance. Downside capture. How do we do in the down markets? In up markets, everybody does well. How do we do in down markets? 41% downside capture, which means if the market was down 10%, we were only down 4%. So that is reflected in superior risk-adjusted ratios. And by the way, it is better than any of the popular mutual funds. So mutual fund सही है, लेकिन हम बेहतर है. Example of how we did in the most recent correction. Uh, you know, small cap went down 25%, we were down 14%. And today, from that starting point of the correction till date, we basically have recovered completely. Small cap and the overall broad index are still down. Now, one of the interesting thing about the reason for this performance, and because when we were in September 24 or a period before that, and there was a lot of talk about correction coming in small cap. And we were cognizant of that. We had gone through that in 2018-19. We did not do too many adjustments to our portfolio because we had faith in the stocks in our portfolio that even if they go through a correction, they will eventually bounce back because of the quality of the businesses. And we measure quality of our portfolio in a very unique way. We call it Sameeksha ratio, which is a combination of return on equity, price to book, much better valuation metric than price to earnings, and interest rates. These are the things that matter the most to valuation above anything else. On that basis, on 30th September 24, Sameeksha ratio was significantly lower than that of small cap index, mid cap index, and Nifty also. So this gave us the confidence that we are holding the right set of companies and they will do okay in a rough market, and that's why we don't have to panic. And that I think played out pretty well. And even today, if you look at the valuation of our portfolio, it is comparable to Nifty, but significantly cheaper than small cap index or mid cap index. So, this is important because, later on, if you look at the markets today, there is definitely a lot of high valuation in the small and mid cap space. I think Nifty and Nifty Next 50 are reasonably valued, but there is a lot of froth in that area. So there is that issue to face. But I think having the right set of companies does help in that situation. We have gone through periods where we did not do well, but in general, we have bounced back pretty well right after that. The red years are periods where we underperform, but the performance post that, has been pretty strong. So there are things that go wrong. We learn, we try to constantly learn from our mistakes also, and that plays out, the next time around. So just a little bit about our investment strategy. We run a concentrated portfolio, but not heavily concentrated, and there is a reason for that. We have very clear risk management practice that we don't want to take large positions in companies with low liquidity because exiting such companies is very, very difficult. Either if we get wrong or even when we get it right. So we allow ourselves to have more companies in the portfolio rather than having few very, very large bets in small cap. Obviously, if it's a large cap liquid name, we take larger bets. Focus is on companies delivering superior returns on capital. Focus is on companies that are participating in our growth story, India's growth story, and we are big believers, like many other investors, in the growth opportunity India has. We look for quality of the management like everybody else, but we are probably more stingy about corporate governance than many of our peers. We follow a very elaborate checklist. And when I say checklist, it is like the airline pilot going through the checklist. And we have also, put in technology behind it to make sure that it is rigorously followed. And so if there are red flags, we stay away from those companies, even if business may look great. And most importantly, when we invest, and this is where I just want to make a correction, that we are growth at reasonable value investors. When we invest, not reasonable price, there is a difference between price and value. When we invest, we must see an opportunity to generate returns that meet or exceed our required rate of return. And our required rate of return varies, depends on the business. Higher risk, higher required rate of return. lower liquidity, higher required rate of return. So at point of investing, we look for minimum 12% if it's a large safe company to as high as 24% return required over a horizon of 2 to 3 years. Then only we invest. Absolute return mindset. Not looking at peer valuations, not looking at relative valuation, and this is all dependent on cash flow generation. So our valuation focus is on free cash flow. If we don't find enough investment ideas, money can stay in cash. If we get a new account, we don't automatically replicate existing portfolio. We don't do model portfolio approach. We only invest in the stocks currently available at our entry price. And we stay invested in that stock as long as the incremental returns over subsequent 2 to 3 years are still meaningful. If those returns reduce to very low number, we start exiting the stock. We may keep some position if the growth momentum is there, but we definitely reconsider our position there. So we are very active investor in that sense. We have to find new ideas. We require to do more work than some of our peers because we are very active. Our portfolio is very active. In fact, our churn ratio is also higher, but churn is one of the factors finally, the most important factor is the outcome, rate volatility. So we have achieved lower volatility while having somewhat higher churn because of the active investment strategy. You are investing in us, you are looking for active investment. You are not looking for a buy and hold portfolio. Um, so, investing, frankly, is a very boring, very laborious activity. It is day in, day out going through, 100 plus items in our checklist, asking many questions, rejecting a lot of companies that otherwise may great, but valuation doesn't support us. Figuring out answers to the questions, traveling across the country, sometimes even unannounced. We have had situations where we showed up at a plant without informing the company because we thought the company was not telling us the truth. Whatever we do is documented. Today, after 10 years of work, we have a very rich set of data on companies we have worked on. And we are now using, the modern technology, some bit of generative AI also to take advantage of that. As I told you, we have in-house software development effort. And the entire research process is mapped onto our technology platform. So if an analyst is going through the process, and we have a very large research team, by the way, because of all the things I said so far. Every step is checked, whether that step is completed or not. So that way, the risk of human, from missing something are reduced. There is a strong internal review process on every investment decision. I think I mentioned about where the market is today. The green Nifty next 50 is one area where we feel comfortable with valuations, or even the bear bonds or yield ratio. But overall, there is a lot of red. So indeed, there is a bit of challenge with valuation in the market. There has also been some challenge with growth. We have seen a bit of a slowdown in the June quarter, September quarter. Let's see what happens. I think there is some bit of earnings slowdown in the economy, despite many positive factors. But we think that one of the things that we have believed in over last 10 plus years is that this government is very focused on economic growth. Whenever they see something not working, they try to address it. Like they, for example, realized that there was an major tax cut, so we saw that. And there are a number of positives for our economy as well. Crude oil being low. Obviously, the U.S. tariff is a challenge, but unfortunately, fortunately, U.S. is not a major part of our export story and the good side. So I think we continue to remain, hopeful that there will be a stronger economic recovery and earnings growth, and accordingly, we are uh, any drastic call on our portfolio, though we do have a fair bit of cash right now. So maybe I can talk about a couple of investment examples. Actually, this is from inception till 30th June 25. The stocks did well in our portfolio. Some of the mistakes that we also, stocks that did not do well in our portfolio. I would say you would find it to be a somewhat uh, different than a typical fund that you might come across. Combination of large caps, mid caps, and small cap. Uh, I'll uh, I'll talk about a couple of names more in detail, but I think I would like to touch upon some of these names which may give you an idea of how we select stocks. Uh, for example, say Deepak Fertilizer. It's a company that was expanding its product line. Somewhat difficult sector to analyze, not something that we like to invest frequently, but we saw amazing risk reward opportunity, and that's the reason why we decided to invest, and has contributed greatly. Polycab, post IPO, it was not doing well. People had a lot of concerns about the management, um, but we did our homework. We talked to a lot of people in the industry and felt that this company has very strong presence in the market and very strong management, and growth opportunity for the industry is good, and valuation was favorable. So it turned out to be one of the great investments for us. ICICI Bank was an interesting one because when there was a change in management, the new management started to talk about changing the culture of the bank. Now, that is not easy to achieve. ICICI Bank has had a history of goof ups. But uh, we got interested because valuation was low. The bank, obviously, very strong presence in with a very strong retail network and good technology framework as well. We observed the company for 6 months. We also met the management and a few other people and felt that these guys were walking the talk. And it turned out to be a great investment. Around the same time, we also had exited HDFC Bank because of the technology issues that they had. Muthoot Finance was a stock that was available at great valuation for many years while delivering strong growth. And so it perfectly fit our portfolio. Lot of names in this portfolio, whether it's Polycab, JBCam, the first two names I'll talk more about. Prudent, Finolex Cable, the sell side research won't be much. Reddington also. Institutional ownership won't be very high. And those are the kind of stocks that fit our framework because of the valuation frame focus. Anand Rathi, in fact, Samyak, if you want to talk about it, I'll just. I also have a couple of my senior research analysts here today with me. So I'm just calling one of them to talk about.
One is customer focus and second one product focus. They were focused on delivering the products which yields better alpha, focusing on equity mutual funds and structured products. Similarly, their focus on clients were 5 to 50 CR buckets, and that actually resulted well. Our performance says that the total return since inception buying and first trimming was 5.5x. And the company delivered strong growth. Like if we take about last 13, 14 quarters, then the company delivered mean and median PAT growth of 33% with just standard deviation of around 4 to 5%. The company's portfolio has delivered a 3 to 4% alpha over their benchmark index, and we invested in the company because it actually were guiding for 20 to 25% growth, and we believe that the company can outperform it. And actually, it met our expectations, and the company has delivered more than 30% growth.
Yeah, so let me also add, how this stock fit into our framework also a bit more. Uh, Again, a stock that was just listed, trading at very low valuations compared to the peers, and low valuation compared also to its own growth rate, what they had delivered. There was apprehension with the name Anand Rathi because of some past history with their broking business. But when we looked at Anand Rathi Wealth business, went through our checklist, we did not find any major issues except that for their structured product, the relationship was there with a related entity. Their structured product business is not easy to understand. In fact, most people say it's too risky. It required a bit of understanding of derivatives to know what risks they were taking. And so we sat down with them and they went through how exactly they manage the risk. And we were convinced that these guys know this. And in fact, they are the only game in town. They are the only one with such a consistent and strong offering in this area. We spoke to clients of Anand Rathi, why they like this product and how Anand Rathi took care of them. When this, you buy this product, it has certain years of, lock-in, it matures. If the market is down when it matures, Anand Rathi will roll it over to the next 5 years or next whatever period. So investors did not have to worry about exiting at the wrong time. The other part of the business was mutual fund offering. And they were analyzing the mutual funds the same way I would do it. So I felt that these guys were the only ones that I found in the market analyzing the mutual funds the right way. And they only offered these two products. Now, one is the offering, second is how do you go to the investor. So in their sales force, the relationship manager, very low attrition. They were all getting excellent growth opportunities in the company and as a result staying with the business. So it ticked on all check boxes, and wealth management as an industry has a huge growth potential in India. It's still very small. So along with the growth in the Indian economy and market, this industry would grow. So it turned out to be a phenomenal investment for us, and we continue to hold the stock. A second one, far more difficult to convince people why we own this stock for many years. Today, I don't think it is that difficult. But when we first bought the stock back in 2017, it was reasonably recent in terms of its IPO. There is still number of players in the airline industry, and historically, most people haven't made money in airline stocks. So first question people ask is, why are you investing in an airline company? But Indigo appealed to us because we had seen success story of similar companies in other markets, Southwest Airlines in USA for many decades. Although, last 10, 15 years, they haven't done well. But there was a period of 20, 30, 40 years when they did well, and Ryanair in Europe. So there was something about a particular business model in the airline industry. If somebody followed that properly, there was a way to make money in this industry as well. And Indigo was one notch above those. In their strategy to purchase aircraft, they were able to strike amazing deals. So they had a cost advantage from that, apart from the cost advantage of the way they were running the airline. We also observed that every time, this industry is a difficult industry, right? There are many things that can go wrong. COVID comes, this industry gets impacted. Crude oil price goes up, this industry gets impacted. There are a number of things that don't go wrong. But every time industry went through a difficult phase, Indigo gained market share. So when we purchased the stock, well, they started with a zero market share, obviously, in 2007. by the 2017, they already had more than 30% market share of Indian market. And they had gone through a few rough periods in between. By the way, Indigo did not, for many years, did not have political support from NDA because there was some past history with UPA. So there was that factor as well. And despite that, they kept growing through every difficult period of the industry. And that's why today they are basically two-thirds of the Indian market. Never in the history of airline industry, anywhere in the world, has one airline owned two-thirds of a very large and high growth market. So all the rule books or whatever anybody has written about investing in airline, throw it out. Doesn't apply. Because two-thirds of a market growing at double digits never happened before. And by the way, India, again, this fits our growth opportunity criteria because India has huge pent-up demand and multi-decades of growth ahead of it. So, and by the way, we also exited the stock. COVID, we were not owning the stock. Later on, again, we reinvested. So it is not that we bought in 2017 and have owned it all for last 8-9 years. In between, we also exited and re-entered. So yeah, I think that's, I got less than a minute to go and I'm done with my presentation. I take any question or I can take one question, yeah. So it's a price to book divided by return on equity minus interest rate. Simple.
And next question, sir, is like, I think last few quarters, the corporate earnings have been subdued. So how do you see, like, and also the market is overvalued. So how do you see, the opportunities in this difficult market?
So I think that's why market is also going sideways right now. There is, I told you, there is a genuine concern. But when you look at the factors that ultimately drive growth in our economy and as a result corporate earnings, they're all looking pretty favorable. Government is committed to spending more on infrastructure this year than last year. There is a lot of fiscal position of the government is extremely good. Inflation is down, so interest rates have started to go down, so that is also positive. Big tax cut for income tax, so that should have some positive impact. Crude price is low and they're likely to not shoot up, so that is also positive. So I think there are a number of positives, and I feel that if the economic issues persist to some extent, government may take additional steps also. That's what we have seen. That's what I count on this government. So I don't have any magical answer or exactly how the corporate earnings will start to bounce back or demand will start to take up. But I think we have to believe that the setup that is today is conducive to positive to recovery rather than further decline.
Thank you, sir.
Thank you. I can either me or Samyak we can answer any other questions later on during the break or whatever. Thank you.